Hello and
Ooh.
welcome to our presentation. I'm just going to give it a few minutes to let everyone join. If you can, just before we begin, if you could just make sure you let me know if you can hear me. If you could just pop in a message in the messages to say that you can hear me, and also let us know where you're from. Always interesting to see where people are joining us
Yeah,
from. It's usually quite far and wide. Hi from Greece, says someone.
Geneva, France, Germany, Denmark,
Cool.
London, UAE. I hope you're visiting eToro now.
Wow, people from everywhere.
South
Um,
Africa, Newcastle.
Welcome to everyone. I'm Peter Martin, by the way, and I'm here with Matty, who is joining us for the presentation, for at least for part of it. And we will be starting very shortly.
We had a really sad day yesterday with losing one of the legendary investors, Charlie Munger, which is, I don't know if everybody knows him, but he was the right hand of Warren Buffett for many years. So he has like a huge part of the success of Berkshire Hathaway. I think Warren Buffett even wrote that without him, Berkshire would not succeed this big. I had the opportunity to meet him few times in my life, and he's a very interesting guy, funny guy, and I think aside from investing, he has so much wisdom for the world, for the humankind and everything that it was just fascinating. I remember to listen either to his, interview on the Daily Journal where he gave 4 or 5 hours of Q&A, and then in the Berkshire annual meeting. Uh, so yeah, that was nice.
Cool. Okay, well, I think we're ready to start now. And so, welcome to number 9 in the Advanced Aspects of Trading course. After everything up to this point so far, we've really been sort of on a kind of strategic level, really, a kind of stock picking almost level. And taking a slight change of tack today to talk about something that is no less important, which is risk management. So, talking about looking after your risk capital, talking about which is money management, talking about decisions about choosing what size to trade, position sizing, and other issues that all fit under this umbrella of risk management. And a lot of it does come down to the individual because I can't just give you one size fit all rules. It comes down to how much risk capital you've got and your own approach to risk. But I think from this talk, it's a win if you do nothing more than become more mindful of risk and actually put some thought into what, for example, the worst case scenario might look like when you're taking a trade, and then taking steps to try and stave off the risks and create a contingency plan to ameliorate for those your exposure in that kind of condition. So let's begin now. And first of all, I do just want to draw your attention to this disclaimer. If you could please have a read through of that as usual. And I would just like to stress that everything I talk about today is for education purposes only. None of it is investment advice. It's not a personal recommendation. The whole idea is to really get your juices flowing, get you thinking about the risks of trading, what you can do to improve the risks or improve the situation, and just to expand your knowledge. So have a good read through of that, and then we will talk about what's coming up in the talk in our agenda. So the first thing on our agenda is to talk about risk. What do we actually mean by risk? How do we define it? And then one way of defining it is this idea of variability of returns, which we'll discuss a little bit. It's more relevant really to investment funds necessarily than trading, but we'll talk about that because it is a part of modern portfolio theory. And then we're going to talk. Yeah.
I'm sorry to cut you. I just see many people saying chat is only for Realtor, not everyone. And someone asked if we're sharing the screen. So first, let me ask everybody, are you seeing the screen that Peter is sharing? Yes, so the screen is okay. And for the chat, you guys cannot see each other's chat? No, so only the chat. This time Peter is the host, so we can solve it. Let me just see how. 1 second. While in the meeting, tap more and then tap security under allow participant to tap chat. We choose from the following options. No one disabled in the meeting as host only. So,
right, how about now? Try have a go now.
Yeah, can someone just, so can you guys see each other? Yes,
right,
done, bingo.
Cool.
Okay, so
excellent.
now write where are you all from so everybody can see it because no one saw it. I'm sorry for the thing, but yeah, it was worth it.
Cool. Germany.
Peter,
Ireland,
you can continue.
Norway.
I'm sorry.
Cool. Yeah, sorry about that, guys. Okay, so we're going to talk about this important concept, which is the risk of ruin. It's this idea of things that can take you out of the game, something really important to think about and what we can do to try and reduce the risk of ruin. And then really the nitty gritty is money management, what we can do to protect our risk capital. We're also going to talk about price shocks, which ties into the idea of risk of ruin, just really trying to look at the worst case scenarios. I'll give you some examples of very extreme price movements, black swan events. And then we'll finish off our talk today by looking at stop placement. That sort of has some overlap with stuff we've already looked at in the technical analysis part of our presentation. And we'll talk about position sizing. As usual, we're going to finish up with a Q&A session at the end. So if you have any questions as we're going along, make a note of them, and then you'll have a chance at the end to put them in the Q&A session section of Zoom, and I'll address those questions as best I can. So here we have a quote from a pretty smart guy called David Tepper, founder of Appaloosa Management. It's a hedge fund with roughly $14 billion of funds under management. And it's one of the best performing funds coming out of the financial crisis. And this quote is saying, does being a risk taker mean not being afraid of losing money sometimes? Then I'm a big risk taker. Does it mean putting the firm in jeopardy? Then in that case, I am not a big risk taker. And really this is, it speaks to the balancing act that money management really is. Almost trying to find that Goldilocks level of risk to take that allows you to get the rewards that trading potentially offers, but without exposing yourself too much in doing so. So as I said, speculation is, or investment is always a trade-off between risk and reward. Looking for a reward, it's why we trade. But to get that, we have to take on a certain amount of risk. Now, different traders will have different risk tolerances. So you know yourself the best, so you will be the person who's best positioned to tailor how much risk suits you the best. Now, it's something that's worth bearing in mind to try and be honest with yourself. When we trade, we don't feel any pain when we take on a trade when we're winning. So traders are usually more interested in the reward side. It's very easy when everything's going well to not really think about risk. You just, sit there and you don't mind scrutinizing your trades that are going well, patting yourself on the back. But when they go wrong, it is all too frequently something that occurs, is that people almost bury their head in the sand and don't really want to know about things when they're going wrong. And that creates this danger that you aren't properly scrutinizing your losing trades, even though risk is part of every trade. So every time you open a position, you are taking on some risk. And that if you bury your head in the sand, if you ignore that risk, it follows that you cannot manage the risk properly. So whenever we trade, no strategy wins 100% of the time. So it's an absolute requirement, therefore, that you must learn how to manage losing trades properly. And of course, that means not ignoring them. Now, what do we actually mean by risk? Well, in plain language, risk is the chance of something bad occurring, of things going wrong. It's a bit more sometimes defined in more specific ways, and some of these ways are listed here. One of those ways is variability of returns. This is more applicable generally to investment funds and investments, but it can be applied to choosing between two different assets or stocks, or choosing between two different trading strategies if you can see what the returns that the strategies give. So we're going to touch on that briefly. Volatility is also used as a way of defining risk. And then drawdowns, we can think of drawdowns as almost being the pain you feel from your positions. Strictly speaking, it's how much your capital goes down from peak to trough. We're going to focus for the most part on this talk on about realized losses per trade and drawdowns, which are more of interest to us as traders. So we're just going to talk quickly about variability of returns. As I said just now, it's more of interest to long-term investors, but this could apply if you had two different trading strategies and you back tested them and you saw that you got returns over a period for each one and you're trying to compare them. Variability might be able to tell you which one is preferable from a risk perspective. So what I've got here is two hypothetical funds, Fund A and Fund B, or Investment A or Investment B, and we can see the percentage returns by year for each. So year one, A returns 3.3%, B returns 3.9%, year two, 3.3% again for A, 3.4% for B. Year three, they both do less well, 3.1% for A, only 0.5% for B. Year four, the same again for A, 3.1, much better year for B, 4.25%. Year five, 3.2% for A, B outperforms it again there with a 4% return. If you were just looking at those year by year returns, it's not that easy to work out which one you might prefer. If we look at the annualized returns over that period for both of them, they actually have the same, which is 3.2%. And then there's a question, which is better? So in the chat, someone says A is better. Someone says B. Maybe they're the same. Do you think there is any difference? Does it make a difference? Let me know. What do you think? Well, from a variability returns or a risk perspective, A is considered preferable because B had more variable returns. We've talked in passing before about standard deviation, a statistical measure that measures the dispersion of data, how much it moves away from the average. The standard deviation of B is larger than standard deviation of A, and therefore B is considered more volatile or more risky. This is the conventional thinking. However, if you've ever seen the movie, or you may have seen the movie, The Big Short, which is based on a book called The Big Short by Michael Lewis, there's a person in the book called Dr. Michael Burry is played by Christian Bale in the movie. And he has a very different opinion. If you've ever read The Risk, he says real risk is not volatility. Real risk is making stupid investment decisions. And a quote from him is that the wealthiest of the wealthy and their representatives have accepted that most managers are average and the best ones are able to achieve average returns while exhibiting below average volatility. And he just had a slightly different view, but he's an unconventional thinker. The conventional thinking is that you've got two investments that offer the same return, but one is more variable. Then people would be sensible to choose the less variable of the two. And that would apply for, as I say, if you're looking at a trading strategy or a trading system, and you can see what the returns are over a period of time, the one with the less variable results would be the one that probably would be the more sensible choice. Okay, so protect yourself at all times. I don't know if you ever watch a boxing match, but at the beginning, the ref goes to the fighters and explains to him what he's looking for. And he says, I'm looking for a good, clean fight. And he doesn't want to see any fouls. And he says, here's where I see the belt, don't punch below there. And then he says one final thing that sort of overrules everything, which is protect yourself at all times. And I think the same thing applies to trading. Regulations exist to protect individuals and retain the integrity of the markets, and those regulations are really important. But ultimately, the person you have to rely on to protect your capital is yourself. So it's really important that you're always thinking about this: protect yourself at all times. And unfortunately, a frequent mistake that can be observed is that many new traders who unfortunately don't go on to be old hands at trading take on too much risk. They're too aggressive. Now, there can be a time for aggressive trading. We began with that quote from the head of Appaloosa Hedge Fund Management, who said he can be. It was that balancing act. He says he doesn't ever want to put his firm at risk, but he will take on risk, have a chance of losing when the time is right. So there can be a time for aggressive trading, but it's not when you're trying out a new strategy or testing the water with a new market. So when you're starting out, you just want to dip your toe in the water. You probably want to start as small as possible. And a natural progression then for a new strategy, if you're trying it out, is to back test it first of all. See how the numbers look in the past, then try and test it out in demo with virtual funds. eToro makes virtual funds available to you in their platform, so you can actually try it out where you're not just doing it against past data. You're trying it out now, seeing how it performs with real markets for future markets where you don't know the uncertainty of the future. And then when you've gained some more confidence, start in small size when you switch to using real funds. And then there's plenty of time later on to increase your size as you gain more confidence, once you've had the chance to smooth the edges away of your new strategy. So let's just talk about a kind of hypothetical example of a trader who is trading too aggressively. So let's just consider a trader who's starting out and his total risk capital, let's say for the purposes of discussion, £18,000, and that they are fortunate enough to have developed a trading signal that, when they've tested it, correctly picks breakouts 55% of the time. So we're talking about someone here who's got a strategy that they've shown by testing it works. It's better at picking breakouts correctly than it is wrong about it. So it gives false signals 45% of the time, though. So you are going to have losing trades quite a lot of the time, but generally it's going to give you winning signals more often than losing ones. And they decide to risk £2,000 on their first trade. So it's a portion of their risk capital, and it proves to be a winner, and they make £800 profit on that trade. They then decide to risk £3,000 on their second trade. That's also a winner. and they make a £1,200 profit on that trade. So what we're talking about, they've got off to quite a fortunate start. Their risk capital is now £20,000. And what they decide to do is, okay, this is going great. Let's just up the size. They need to trade more aggressively. And so they risk £5,000 on the next trade. Now, on the face of it, this doesn't seem too crazy, I suppose, because they have been winning. They've upped their size accordingly. But let's say that bigger trade then goes wrong. We know that they're going to lose 45% of the time overall. And they lose the £5,000 and their capital is now £15,000. And they decide to maintain their risk at £5,000. If they do that, although it's still a portion of what they've got, it only takes 3 consecutive losing trades to wipe out their entire account. And the odds of that happening when they've got a losing percentage chance of 45% is 0.45 times 0.45 times 0.45, which is 0.091 or 9.1%. So there's like a 1 in 11 chance of just wiping themselves out, of losing everything they've got. That's really quite substantial if you think about it. And what they've actually done, it's a winning strategy they've got, but there's a chance, there's a way, if you trade too aggressively, to turn a winning strategy into a losing one just by wiping yourself out. So this is one of the things that we really, really want to avoid. If your risk capital is all that you've got for trading, if it declines too much, then you're not going to be able to trade anymore. You'll be taken out of the game. And this can happen via 2 paths. You can just have one sufficiently large single loss that just wipes the whole loss out, or you just go through an unlucky sequence, probability being what it is. There's always a chance this might happen, and you get a sequence of combined losses. So the diagram here just shows you that in a kind of illustrated form, your risk capital, and then game over on the right. We can get there one of 2 ways: drawdown from a sequence of losses, or just a drawdown from a single big loss. So this game over is what we call the risk of ruin. And that is what money management aims to avoid. It's ensuring you don't get taken out of the game. I mean, inevitably, bad times will occur. We spoke, if you think all the way back to when we were talking about the macroeconomy, about the business cycle. And the business cycle is all about the idea that the economy oscillates between periods where the economy is growing and strong, or times when the economy is not going so well, when it's contracting. And those will be the inevitable bad times. And also inevitably, if with there being any chance of getting a trade wrong from a strategy, then there's a chance of getting a sequence of trades wrong, even in the good times. So good money management helps you to try and keep going even in the bad times. It's all about preserving your trading capital, but that has to be balanced with aiming for maximum profit potential, because you don't want to go too far in the way of, okay, well, I'm going to preserve my risk capital. I will take very, very low risk. The trouble with doing that is that you're not maximizing the profit potential from your strategy. If you've got a winning strategy, you do want to make sure you're getting a nice reward out of it, so you can't just trade a tiny size. But there is no one size fits all answer. As I said or alluded to before, we've all got different risk tolerances. We'll all have different amounts of money that we're set aside that's available as our risk capital. So the right balance has to be tailored at your discretion to you personally. That is just true of trading in general. Ultimately, it's your discretion that rules the roost. So money management, in a nutshell, we can just boil it down to 2 things: loss management per trade and position sizing. Loss management what we're talking about there really is an exit strategy, thinking about how to get out of a trade if it's a losing trade, if it's going wrong. Using a stop loss is a key tool in doing that. Position sizing is trying to find that prudent amount per trade, that balancing act, that Goldilocks amount that gives you the potential to take a decent profit whilst not taking on too much risk. And always bearing in mind with both these things, with loss management per trade and position sizing, just remember the risks are real and we need to be wary of how they might affect our capital. Always be thinking about that. And as I said, we're trying to find a prudent amount of risk that gives a good profit potential. So that's that balancing act. So let's talk about risk as an exposure of a trade, which is one way we can define risk. So a risk of a trade in isolation, we can loosely quantify it as the risk of the trade equals the size of the position, the size per unit movement times the stop distance in terms of unit point movements or unit movements of that instrument. So this is where position size is expressed as a value of currency per point of asset value movement. Stop distance is expressed in the same points of asset value. Now we say loosely because of the possibility of slippage. So slippage is the idea that even though you have a stop on a position, you may not necessarily get out at that level. Stops are useful and excellent tools, but they're not perfect. In normal market conditions, they will protect your losses. But having said that, let's talk about circumstances where they don't work so well, which is extreme market conditions. Oh, actually, sorry, I've missed out this slide. So stop, key tool, as we say, in trying to draw a line under the risk per trade. So it's a tool that can prevent a single large loss. If you're trading using leverage with eToro, the good thing is their platform always puts a stop on your position. So it's sort of prompting you to think about this or do this anyway. It explicitly sets the level at which you're going to get out of a trade. But even if you aren't dealing with leverage, if you're actually physically buying stocks, you put up the whole amount, you don't automatically get a stop. You might want to think about having one, maybe a mental one that gets out, or even putting a stop trade to get you out of the position anyway. It quantifies the risk of the trade in normal conditions. And also that helps you to sort of give you a benchmark to compare against subsequent gains. So you can work out things like ratios of risk to reward. Key thing to always bear in mind. So the aim of what you're aiming for is for your gains to outweigh your losses. I think that's it's almost a truism. It's pretty obvious, but sometimes people don't sort of spell it out quite this way. So it's useful to bear this in mind because what it really implies is that if you're putting a stop on a position, you want it to be closer so that your losses are smaller per trade than what you're actually ultimately aiming for. You want to be taking bigger profits in general as a whole than your losses. But it is no use against an unfortunate sequence of losses. So although it reduces the risk per trade, it can't do anything to make you, we talked before about a person who has a 55% chance of getting it right, 45% chance of losing. There's still that quite substantial chance that they get a sequence of losses, and we have to make sure that those sequence of losses aren't going to eat so much into your risk capital they take you out of the game. So you need to plan for that. So the way a stop works is that it is an order to execute a trade in the market if the price touches a specific level away from, in other words, less favorable than the current price. So the sort of actual mechanics of how it works, if you were putting a stop through a broker into a futures market, for example, is that the stop becomes a market order in order to deal at market once the level is touched. So then you try and trade at the best price available. But that does mean that it doesn't always trade at the level you've given. It can be worse or much worse, depending on market conditions. And that's an example of how volatility plays a part in risk. If volatility is very high, then it's going to increase the chances of this idea of slippage, which is the difference between the stop level and the fill level. So if you're not filled at the exact level you were hoping for, the difference between the two is called slippage, and it can mean in extreme market conditions you can lose more. As I said, in normal market conditions, usually you've got a great chance of getting closed at your actual stop level. But if the market does something funny, there is a risk that you need to be aware of. So having said that, in normal conditions, stops work very well. Let's actually talk about where they don't work well. And that brings us on to price shocks. So it's always worthwhile, if you're trading a market, try and get a feel for what the worst case scenario might be. Actually try and expose yourself to a bit of pain before you've actually got any skin in the game. And just go back at the history of that market. Look at the charts long term. Go back a long time, 10, 20 years, and see what's the worst that market has done. Because that might just alter your thinking a little bit, just to make sure you are on the side of caution. How bad have things got in the past? What would happen to your strategy if you're trading a certain size, if history repeated itself and that kind of size that you've seen in the past happens again? And it's not that unreasonable to think, if something's happened in the past, could it happen again? Well, I would tend to think it possibly could. Some examples of what I'm talking about. We rewind to the financial crisis. I don't know how well people remember this, but you go back to 2008, the bankruptcy of Lehman Brothers. One of the things that's actually talking about the movie, The Big Short again, that's one of the things featured in that. Lehman Brothers, it just dropped a really substantial amount. On the 15th of September 2008, it dropped 92% in share price after failing for bankruptcy. Also, as part of the financial crisis, the Dow dropped 777 points in one day, around about 7% of the index. That was on Monday, the 6th of October 2008. And if you go back even further, there are more extreme price moves of the Dow that have happened in the past, certainly in percentage terms and even in points terms. And then I've got here about the SNB. It's the Swiss National Bank. In 2011, they intervened in the market. The SNB has a bit of a track record of intervening. So it sort of says we're trying to achieve certain things, and it will buy or sell vast amounts of Swiss francs in the market to try and change the exchange rate if it feels necessary. So what they did there was they put in place a peg against the Swiss franc of 1.2 Swiss francs against the euro, saying that they would no longer tolerate the euro being worth less than 1.2 Swiss francs. When that happened, it made massive ructions in the foreign exchange market. Dollar Swiss jumped 500 pips in a matter of moments, which is more than 7%. So these things really can jump a lot. Oh, and I've also got here about Credit Suisse being taken over. That was this year. UBS managed to get itself in a bit of a problem. It was sort of rocked by a number of scandals, including that it announced that it found weakness in its financial reporting, which is the kind of thing that's completely destroys confidence. Is this saying that the actual financial reporting might not be right? And then one of its major investors, the Saudi National Bank, said they wouldn't provide it any further funds, and it ended up actually needing a big bailout, and then it was taken over by Credit Suisse. So let's talk more about that. What happened with Credit Suisse this year, an example of extreme markets. Let's say it's Friday, the 17th of March, 2023. Shares in Credit Suisse were trading at 198, bid 2 offered in Swiss francs, near all-time lows. We'd already fallen off an extremely large amount at this point, and this is one of those examples perhaps of trying to catch a falling knife. You decide to go long and buy 5,000 shares at a price of 2 Swiss francs per share. Obviously, Thinking of the risk, being wary of the bad news that has driven the price down, you decide to place a stop and you put it at 180. So ostensibly your risk is 0.2 Swiss francs away times 5,000 shares is 1,000 Swiss francs, which is something like 1,150 US dollars. Over the weekend, UBS agreed an emergency takeover of Credit Suisse with the Swiss National Bank, and shares in Credit Suisse opened at 0.91. So this is one of those examples where there is no mechanism for your stop to trade where you wanted it to be taken out. It gaps through your stop level and you just get taken out at the best available price. So your stop becomes a market order at the opening. You sell at the best available price, which is the current bid. So let's say you get out, you sell your 1,000 shares at 0.9 Swiss francs per share. You opened at 2, you closed at 0.9. So you lost 1.1 per share and you had 5,000 shares. So you'd have lost 5,500 Swiss francs, around about 6,300 US dollars. Bit of a scare story, but just something to be aware of, that extreme moves can happen. So as we said before, loss management, one way is to consider using a stop. That can be a mental stop or an actual stop. As I said, with eToro's platform, if you're trading on a leverage basis, then they will put a stop on your position anyway. But don't just put the stop anywhere. Have a think about where you actually want it, how much you want it to, what you're trying to risk. Also, you should be trying to monitor both the markets and your profit and loss frequently. If things are going bad, it's actually more of a reason to manage it even more closely, and also assess regularly whether volatility is changing in the market. Are market conditions starting to differ? Keep up to date with financial news and events. I think this kind of goes almost without saying. Don't leave a position without a stop if you aren't in a position to trade. So this might be if you've invested in some shares physically and you haven't got a stop on the position. It's not done as a CFD. If you're doing it as a kind of trade rather than you're definitely going to hold on for years and years, if you're going on a long flight, it might not be such a good idea. You might want to try and work some kind of stop order just in case. When you are putting a stop on a position, it's really important to actually think about where that stop is. Don't just do it without much thought or just I'll just put it a round number or something. Try and use support or resistance zones as guides. So this is going back to some of our technical analysis talk. Have a look at where you can see previous support or resistance to try and guide you as where that you might think it might be a good level to get out if you're wrong. But you don't want to put it so close that just kind of normal minor fluctuations, the normal oscillation of the market, the noise of the market might take you out. So, and to try and maximize your profits, you might want to consider thinking that placing it closer than where you're aiming to take profits. So getting that idea of getting your profits to be larger on the whole than your losses so that you win. And try avoiding obvious levels such as round numbers. So, if an index is trading at 6,000, don't put your stop at 5,900 or 6,000 even, which is a round number. If brokers are putting stops in the market, they don't actually advertise that they have them working in the market. No one can see where a stop is. But sometimes if people get paranoid, I remember speaking to clients in the past where they was asking does the market know? Can they see where they are? Because you have this strange thing where the market seems to be able to find out where the stops are. No one can see where a stop actually is in the market, but people can make sort of educated guesses. Market participants can sort of, if an index is trading at 6,013, they might say, okay, there might be some stops down at 6,000. Let's just try and temporarily knock the market down there and find if there are. So what you really want to do is to put your stop as a trading level where you think is a good level to trade. Use market volatility as a guide. If volatility is high, you might want to think to be erring on the side of putting it further than you would otherwise. You can also use moving average levels as a guide. And this final point really is just the key point, is the crux, is you put a stop on. It's as much of a trading decision as opening a trade, because it's deciding when to get out. So think about it in those terms. Where would I want to be if you're long? Where would I want to be as seller if I was wrong? If you're short, where would I be a buyer? And think about that level first before than just thinking about the actual dollar value of a position. Don't just go, okay, the stop can go anywhere as long as I'm only risking $200. Think about it as a level first. So this is an example of, if you sat through the talk about trading breakouts, this is going back to something we already looked at back then, which is Antofagasta back in 2022. And we had this kind of downwards trend on the left, you can see, and then in the middle, market trading sideways, a bit of a rectangle pattern. And then it breaks out of that trading range, and the breakout became a new trend. So if you were trading it at the time, where you were seeing it bouncing against this resistance that's around about the kind of 1250, 1240 level, we can see this a zone of fairly consistent resistance there. Once it broke out, if you went long, then you might start thinking about, okay, do I want to, where would I put my stop loss? And one way you might think of this is to say, if it goes back below that previous resistance zone, then it's actually just going back into the previous range. Maybe I'm wrong there. So I'm going to use that as some kind of a guide. So let me try and share the eToro platform. If I can find it, there it is. And get rid of that one. So we need to see where this was. It's back here. And that resistance we were talking about, if I just put a rectangle on it, it's sort of roughly this kind of zone here that we're talking about. So we can see it's sort of 1250. You might decide, okay, if it comes back to 1250, I'd be happy, but maybe somewhere a bit lower. Once again, that would come down to the individual decision. You might opt for a tight stop. You might opt for a slightly further one, but really it would come down to, where do I think this breakout isn't happening? This breakout's broke, the new trend hasn't happened. It's just gone back to its previous one. Where would I be happy? And then make your decisions going forward from that. So you pick your stop first and then start thinking about how much you actually want to risk on the trade. So this is just showing the same thing in a bit more detail. Got the resistance zone marked on this diagram. And then what would happen is that first candle breaking through would be the your signal, and then you wouldn't be able to get in until the next day. This is a daily chart. So the next candle will be the next day. And let's say you got in at 1270, and where would you think about placing a stop? Well, what example is just here is that you enter at 1270, you're looking at that previous resistance zone being around about 1230 to 1240. So you could put the stop at 1230, 40 points away. But to give some extra room for flexibility, you might add, let's say, 10%, 44 points away. That would put the stop at 1226. It's a pretty tight stop, but it enforces closing that trade early if you're getting wrong. So, I mean, it's different strategies would have different approaches, but this one would be trying to put a pretty tight stop on and just hoping to then run that, you don't get taken out if you're right, and the new trend happens, that you could run with that without ever having risked too much on the opening. This diagram here shows the same thing, Antofagasta, but with the average true range added at the bottom of the chart. Hopefully you can recall average true range was this measure of volatility invented by J. Wells Wilder. It sort of tells you roughly how much it's moving looking back in the past over a certain period. And then, so this is a 14-day average true range. And we can see that the volatility picks up as the breakout occurs. That's not uncommon, but we might be able to use that as an additional guide for stop distances or working out what you might expect on a given day, how much you might, the worst case scenario rule of thumb, what you might expect if it adversely moved against you, how many points you might be talking about. So we can see that on the entry day, if we had where it broke out, we're talking about something about daily fluctuations are around about 50, sort of in that order, 50, 55, 57 points. If you look at the charter average true range down on the right at the bottom. And so you might decide using that, you might say, okay, 60 points away is just to illustrate a certain type of thinking. So now moving on to position sizing, a major part of money management, as well as thinking about things about where you're going to get out putting stops on, is deciding how much to trade per position. And that should be made with reference to your trading capital, which we've talked about already. So any single trade should only represent a small portion of your capital. So I like to think about this as like talking about how many bites of the cherry do we get. Bear in mind, price shocks can occur and we don't want to trade too aggressively. So let's talk about an example. Let's say that your risk capital is £25,000, say, and you decide that no positions should risk more than 5% of this total. So £25,000 times 5 over 100 gives you £750 maximum per position. Quick sense check on that. If you had 4 successive losses, you would lose £3,000. It's 12% of your entire capital. So let's say that your strategy gives a downward breakout signal on the FTSE 100 at 76.10. You identify 77.35 as a good stop level. Stop distance then is 125 points. Your maximum risk that you're allowing yourself per position, if we were going for this 5% total, is £750. Knowing those two values would fix your position size. So £750 maximum risk divided by the 125 point stop would suggest £6 per index point might be a good size for you to trade. And this is really the order that you want to do it in. You want to start with making a trading decision about where your stop's going to go. Think about how much you want to risk on that trade with reference to your whole trading capital. And then use those two to fix the position size of the actual trade itself. And you don't want to work the other way around, because then you're almost arbitrarily deciding your position size to fix the other two things, which are probably more important to decide on over that. Bear in mind, though, that not all instruments are similar. So volatility can play a part in showing you or giving you some implications for what you might want to do with position size for that asset. And let's assume you use the same strategy. You've got a strategy that you're sticking with for trading and you're just applying it to different instruments, and you've got the same percentage chance of success to all the markets you trade. Then it might be prudent to adjust the position size for volatility, i.e., if the instrument you're looking at has shown that it's more volatile in the past, then you might want to just risk a bit less on that one, so that you can gain some consistency across it. across the different trades you do, so that you're consistently you're trying to gain, you don't know which trades are going to be losers and which one will be winners. So you really want some kind of consistency. So you don't want to have that additional quirk that you might have a losing trade that actually turns out bigger losses than you were expecting. So here's an example of adjusting size by volatility. We've got on the top Goldman Sachs, and that is a daily chart of Goldman Sachs. And below it, we've got a daily chart of Intel. And then also added at the bottom of each chart is the average true range. So just go back to the platform to just show you if you wanted to do this. So if we wanted to so if you ever want to compare two charts, we can compare multiple charts. It's very easy, as I've shown before. But so they've got Goldman at the top, and then we'll put in this one below Intel. And then to add the average true range. So you can get a guide of what their values are. The average true range for currently for Intel is 1.1, and for Goldman Sachs is 5.5. And you can also see that the ratio of share prices is 341 to 45. I'm not going to try and do that maths in my head, but we'll go back to the slides, which will use the slightly different numbers than when I created the slides, but we'll see what the principle is here. So let's say that you decide to buy Intel at $32.50 a share and Goldman Sachs at $3.25 a share. So these were some historical values not that long ago, from a few months ago. And say that your risk capital is $40,000 and that the average true range value for Intel is 1.1. And that is $8 for Goldman Sachs. So, and we also aim for a maximum daily fluctuation of 1% of our capital. So if we have $40,000 as our risk capital and we're aiming for a maximum daily fluctuation of 1%, then that would be $400 per position. Now, for Goldman Sachs, $400 divided by $8 per share means 50 shares. The equity value of 50 shares at $325 per share would be $16,250. With Intel, dividing $400 position daily fluctuation by that 1.1 ATR value gives you 363 shares. And then that gives you an equity value, 363 shares times $32.50 per share of 11,800 roughly. And so what we've got is, because Intel tends to actually be a bit more volatile, then Goldman's it would take a bigger equity value than Intel to try and gain some consistency between them. So because if we're looking at it, that the share prices were roughly 10 times bigger, well, it is 10 times bigger in using these numbers for Goldman, but the average true range was only about 8 times bigger for Intel. So that Intel was more volatile. Yeah, so as Intel's a bit more volatile, we're attempting to adjust the size for the average true range to give an idea of exposure per day. And so let's talk about the nuts and bolts considerations. We need to think about, what is your total risk capital at the outset? What are you starting with? What will be your trading size per deal? how are you going to manage the risk of each position you take? And then if you use a stop, how close are you going to place it? As I've said a number of times, ultimately, though, it is all down to the individual trader to answer these questions, because only really you know what your approach to risk is. So in summary, there's numerous ways we can try and define risk. There's more than one way of looking at it. We talked about variability of returns, volatility, how much you're actually risking on each trade. We want to try and avoid, with our money management, trading too aggressively. Another important part of money management is seeking to preserve your trading capital. Key tools that we can use to do this by putting stop on a position. Position sizing is another important way. The key tools of money management. And then finally, assessing the volatility of individual markets can aid in that process of where to put stops and making decisions about what size to actually trade. Okay, so that is the end of the talk. If you could put in your questions to the Q&A section, I'll do my best to try and give you some answers. Okay, so let's have a look. Okay. Some good questions, well, some quite varied questions. One of them is, could you explain risk management into trading oil trading over the week? Well, we've tried to address risk management from a sort of general perspective. And so those general ideas would still apply no matter what the market. So if you're trading oil, you still want to be mindful of certain things. You want to, so I mean, let's go back to we go back to the charts and we look at oil. So first of all, we've got average true range on here again. So that's something, if this is, it's a daily chart, maybe if you're trading it over the week, let's say that you're looking at a shorter time frame. So let's say that you're looking at maybe you're looking at an hourly chart to trade it over the week. And you might look at what the average true range is, just to give you a steer as to the kind of fluctuations you might see over an hour. So this is saying, you know, hourly, the average true range, the kind of fluctuations we're looking at here are less than $1. If we go back to our daily chart to then look at it for daily fluctuations, we can see that it's up at sort of currently around about 2.5. We had up 3 here earlier in the year. So these might start factoring into your thoughts about what kind of fluctuations, talking about drawdowns, if things go wrong for you, how much pain you're going to be taking if it goes against you per day. Could be looking at couple of dollars in the price of oil against you. So you need to position size accordingly. Also, something that we're going to look at next week, with next week's talk, is going to be a bit about we're going to talk about some of the details of different markets and some of the different information you need to know there. With something like oil, and this is, you'd want to know when market moving data might come out for oil. There's a key piece of information is the a report called EIA crude oil stocks, comes out on a Wednesday once a week in the States. It says what the oil stocks are held at a place called Cushing in Oklahoma, which is a major oil depot and price setting point in America. That would be something if you're seeing, it tells you about supply and demand, that's going to have an effect. It's not quite tied into risk management, but in terms of risk management, you probably want to be aware of something's coming out. You don't want to have a stop that's very close if volatility might be picking up in the wake of the release of a piece of information. So that would give you supply and demand information. If it turns out there's unexpectedly large supplies being held up at Cushing, Oklahoma, it's probably going to create headwinds for the share price. You might see some sharp movements in the wake of that release. Someone else asked, so some of these questions aren't really to do with risk management, but someone said, would you peek at the NASDAQ? I don't mind doing that. Going to get rid of that average true range. So we can see with the NASDAQ, if you were just looking at this from a technical perspective, probably want to add on a moving average. We'll put on a 30-day moving average of the NASDAQ. I mean, we can see that the indications or the confirmation of what in the short term is an upward gradient to that moving average, suggesting or confirming that we've been seeing an upwards trend of late. Not been going on too long, but it's started back there in late October. So we've been seeing an upwards trend in the NASDAQ over the last month. Prices well elevated above that moving average, which is often seen as a kind of another further confirmation of how bullish things have been. And we can see, just eyeballing it, how many green candles there are in a row compared to how few and how small the red candles are. You're also seeing that the pushes, the size of the green candles are generally much bigger than the size of the red candles. So on down days, the range has been very small, actually, and on big days, the range has tended to be larger. So these are some of the things that might factor into your thinking. And then let's get back to someone asked about what happens if you don't use a stop loss. Well, if you were, I mean, it would depend on which broker you're using. If you're trading with eToro, then if you're trading with leverage, you have to have a stop on your position. If you were actually physically buying the shares, then you wouldn't need a stop. Let's say you did that. Let's say, let's look at, just to pick anything, let's look at Realty Income Corp. It's a US stock, pays out regular dividends. Let's say that you decided to put your money in it back here in, say you bought right here at the beginning of the year, $68 a share, and you had no stop, and you just let the position run, then you will have lost 16 of 68. So you'll have lost $16 per share. You're effectively handing over. If you do that, you're investing in the stock, and you can risk all your money. If it goes down to zero, you could lose everything. Obviously, you might have a mental stop, decide I want to get out if it goes down all the way to $40. But if you do that, then you crystallize your loss. I mean, it comes down to a stop. Enforces discipline is one of the other advantages of it. It forces you to think about, what do I do if it goes wrong? It does many things at once. It enforces discipline on you. It forces you to start actually specifying and quantifying what your risk is. It puts in a level that will execute a trade for you so that you don't need to take care of getting you out, all these things. But if you don't have a stop, then your risk is, if you're long, it's limited to zero in theory. And if you're short, your risk would in theory be if you were able to go short without having a stop, then your risk is unlimited. Someone asked, where do we get the average true range value? So, well, the good news is the platform does it all for you. So if we added average true range here, the basic mechanics, what average true range is. So perhaps if you joined us before, you might recall this, that it's, as I said, it was invented by a guy called J. Wells Wilder, invented quite a few technical indicators. He defined true range as being, so we've got the range, which is just simply the difference between the high and the low of the day. But markets that actually do shut, so for example, if you're looking at the price of lean hogs, it trades on the futures market, it would shut at a certain point of the day in the afternoon, and then it reopened the next morning, and it might open at a completely different level to where it shut. So what he called is the true range is to look at the high and the low and the previous close, and whichever gives you the biggest value, that would be the true range. And then the average true range just goes back over a certain period that you would decide. The default value is 14, and it would provide a moving average of those values of the true range. So it's doing all the calculations for you, but it's looking at what that true range is, averaging it. Standard value is 14 periods, 14 days on a daily chart. So this realty income one, we can see the average true range across 14 days is currently just under $1 per share. Just going to check the time. Yeah, so maybe time for just one more question. So someone, this is a very good question. Someone asking why Intel was considered more volatile in the last example as compared to its counterpart. So I'll go back to the platform. So we were looking at, we had Goldman Sachs at the top. And below we had Intel. And so what we were saying is that the share price of we can see that the share price of Goldman Sachs is $342, and then the share price of Intel is $45. So it's a ratio of about 9.8. So that ratio is still, sorry, it's $45. Yeah. I put in 442, it's 342. 342. Ratio of about 7.6. Got this ratio of 7.6. And then if we look at the ratio of the ATR to each other, you've got a ratio of the ATR of Goldman's is 5.6 and the ratio of Intel is 1.1. So 5.6 divided by 1.1 is about 5. So in other words, it's still holding true looking at these current levels. Goldman is 7.6 times bigger in terms of its share price, but the average true range is only roughly 5 times bigger. So in other words, Intel's volatility, if we're saying average true range is a measure of volatility, it has the ratio is 5 to 1, but the share price is nearly 8 to 1. So Intel is more volatile than we would expect, if that makes sense. Just if we just went on the share price, we wouldn't. If they had exactly the same volatility, we would expect Intel to be moving 7.6 times points less reduced because of the ratio of the share price. Anyway, that is the end. Thank you very much for coming or for attending. And next week is our final week. So anyone who's been kind enough to attend all 9 sessions, please come along to make it a 100% attendance record. Thank you for taking the time to listen to what I've got to say. I hope you enjoyed it, and I'll see you next week, hopefully. Goodbye.